Yes, Naren, Executive Director and CIO with ICICI Pru joins us. Naren, good morning. Thank you for joining us. Naren, it's very easy to pinpoint what has gone wrong and what will go wrong. Demonetization, impact of that on the economy, global slowdown and uncertainty because of the Trump era. But despite these nasty headlines, one would argue that markets have been quite resilient.
Clearly, if you look at it globally, if you every day Dow and S&P go to record, it means that the markets are resilient. I guess what has happened is globally, not in India, fixed income was in a kind of a bubble situation, and that bubble got deflated. And since money has to go from one asset class to another, it has gone from fixed income to equities, and that has sparked a good equity rally in most of the world. And that, I guess, is responsible for the resilient outlook for almost all markets. The way market has struck Trump, the way market was not expecting Trump as president, the market ignored the Italian referendum. So I guess clearly there is more money in equity markets right now, which is why the markets have been steadily trending upwards.
Naren, good morning. And the question is, Naren, while there might be individual disappointments to certain quarters of the market based on events, the way they shape up, do you believe the trend, the flows? I mean, we were talking to A. Bala about a week ago, and he said that November has seen astounding amount of inflows into mutual funds, and that means that Indian retail is quite active when it comes to deploying money in the equity markets. Do you think flows will take care of whatever disappointments come along the way and will move from event to event, but eventually move only higher?
See, clearly, what we look at is, we are never believers that flows can satisfy, can create long-term returns. Flows can create short-term returns. It can't create long-term returns. And however, what we believe is over the next 2 years, the entire economy is likely to improve. With capacity utilization being so low, we believe that in the next 2 years, we will see an improvement in capacity utilization and consequently earnings, and that should drive a equity market improvement over the next 2 years. What is holding it back, if you ask me? Partly it is because Indian economy is getting more efficient. As Indian economy gets more efficient, earnings go down, primarily because margins are not what it used to be. If you look at it across sectors, particularly the sectors where a lot of inputs were free, like mining, for example, in all those cases, earnings have gone down. Those earnings going down has hurt the equity market, but I think those are all things which we have to look at more positively.
So, Naren, what's the advice for the average retail investor on the street? Because he's really flummoxed by the movement in equities as well as the bond markets and the uncertainty right now. In the next year to come, what should be the right approach? I mean, is it going to be a little balanced, put your money in both the debt as well as the equity markets? Or do you think it's going to be hands down a win-win for equities in this case, or the bond market for that matter?
No, I think over the last 1 to 1.5 years, we have been very comfortable with this balanced approach. We call it the dynamic asset allocation category. Primarily because we think that neither asset class now, neither fixed income nor equity is dirt cheap at this point of time. And both of them have scope for generating volatility in the near term. And therefore, we have been a big believer in the dynamic asset allocation category over all other categories over the last 1 year, particularly the last 3 months. And we continue to think that is the way to go. And having said that, we still think financial assets is the way to go. So at least for the next few years, the outlook for financial assets still looks much better than that of physical assets like real estate, and which is how we are looking at it at this point of time. I don't believe you can make mega returns in equity at this point of time. For mega returns in equity, you need panic, and we are not seeing any panic. So you have to ready yourself for normal returns, no mega returns, because mega returns are made only if you invest in panic, and that we see missing at this point of time.
In the fact that NBFC stocks are down 15-17%, auto stocks have taken a correction of 10-12%. There is a lot of confusion and chaos about demonetization. The general view is that the economic outlook for next year would be rather dim. So the panic may not look like what we saw in 2008. That was extreme fear. But in terms of an aggregate mood point, the mood point is not bullish. I mean, nobody's feeling happy.
See, nobody is feeling happy, but what they do with their money determines the markets to an extent. If the price to book for some of the NBFCs come down from 5 to 4, would you call them dirt cheap? You wouldn't call them dirt cheap. If you look at auto stocks and do just a simple trailing price to earnings, most of the trailing price to earnings of auto stocks are between 20 and 30. You look at cement sector and look at trailing price to earnings, again they are 20 to 30. So I think when you have trailing price to earnings of 20 to 30 or price to book of more than 3, I don't personally believe that the market is dirt cheap at this point of time. And just because the sector has corrected 15-20%, we are in panic zone. I don't believe. If you look at what the equity market aggregate has delivered over 2 years, it is close to zero. These sectors, some of the sectors you mentioned, they have delivered returns of 100% in the last 2 years. So I don't think a drop in these sectors reflects panic, in my opinion. We are not in panic. We are not in euphoria. We are somewhere in between that, and that is the reason we are in this dynamic asset allocation phase. The entire effort of the government to reduce the size of the black economy, to increase the efficiency in the economy through using digital channels and internet and mobile phone, all these is likely to make financial savings more attractive, and therefore while the return expectations on financial assets have to be moderated, it is still a time for people to look at financial assets in lieu of physical assets.
Naren, I remember, and correct me if I'm wrong, but I think around the on the Brexit day when you spoke to us and the index was trading at about 8,000 or thereabouts, I think you had mentioned that it's a great time for people who don't have investments in equity to go ahead and do that. And you know, the last 12 months, you've picked up some made some really interesting contra calls which have worked out beautifully. I remember metals, for example. What is that big call on the market right now? And is there a contrarian call in the index on within the spaces or themes right now? Because there are lots that is happening right now. There's a bit of a dichotomy. There are some expensive names which are continue remaining expensive, and then some very cheap names which the market is shunning right now.
So if you look at it over the last 3 months, one of our biggest contrarian bets was telecom. But some of the telecom stocks have been very, very firm in the last 1 month. So while they continue to be long-term a very good sector for a contrarian investor, you're buying after 15% outperformance against the market. We continue to think if you look at sectors like financials, clearly there are select financials, not NBFCs, which do look attractive for the next 2 to 3 years. And the near-term outlook is, of course, conditioned by a number of NPLs issues which exist still. But I think over the next 2 to 3 years, financials certainly look like another good sector. We have been extremely big believers that in the next 3 years, the entire power eco chain is going to see an improvement. We think in the next 3 years, power demand will go up by 20%, which means that coal demand will go up, which means that transmission demand will go up, which means that more of distribution infrastructure will be required. So that is a very easy bet that we have, because we are looking at power. If you look at most of the power stocks, and we are only looking at companies which are stable and financially strong, all those stocks have virtually delivered no returns over the last 8 to 10 years, except a few regulated utilities. So we think that power chain is something very attractive for the next 2 to 3 years. We had to moderate our negative stance on consumer. We were negative for consumer for 5 years. We thought that after 2 bad monsoons and a correction in some of the stocks, we need to look at it. So we did, I would say in many of our portfolios today, we do have consumer stocks. For a long time, we used to be massively underweight, because we think that over the next 2 to 3 years, low unit value consumption stocks have to do well. You have had a fairly big rural slowdown for the past 2 years, and after that big rural slowdown, there has to be an improvement over the next 2 to 3 years. So we are believers in the low unit value consumption story. So having said that, I don't think it is easy to find multi-baggers at this point of time. There have been too many multi-baggers in the last 2 to 3 years that expecting multi-baggers from here looks still difficult.
Fair point. So Naren, the consensus view has been buy private banks. They are the ones who are gaining market share. They give you better visibility and the understanding of book is decent. But in this post-demonetization era, a lot could change. Interest rates will come down permanently. That's a booster for treasury income. CASA ratios will change dramatically. Capital requirement changes dramatically. So is there a reason now one should seriously relook at 2 or 3 large PSU banks, at least the top 3 names?
See, we do believe that, the public sector banks, which private sector banks which were focused on corporate banking, those stocks are also contrarian opportunities today. Many of these stocks have delivered a big increase in NPLs in the last 2 years, that they have done pretty badly over the last 3 years actually. So I believe that the corporate banks in the private sector space which got derated, along with the top public sector banks, they all represent interesting opportunities for investment. But you have to have a 2-year view, because what will happen in the next 3-6 months is still not clear. We have to remember that across the economy, efficiency is increasing thanks to the focus on reducing black money and things like that. That is going to reduce margins in a wide variety of sectors, and that is going to have positive impact on fixed income and slightly negative impact on I would say earnings, primarily because margins are likely to come down in many of the sectors. That is my belief, because of increased efficiency.
So Naren, let me get closing comments from you. We are at 8,000 on the Nifty. The P multiple is not very cheap, but we are nowhere close to an historic high. What could be the best case scenario for next 2 years? Because in next 2 years earnings will come, and if earnings will come, we may also see a little bit of P expansion.
See, when investors were not willing to invest around Brexit, I was actually willing to give a target of 10,000 Nifty over the next 2 to 3 years. Given that Indian investors have been investing consistently, I moderated and stopped giving that index target, because now investors are again investing in equity mutual funds and dynamic asset allocation funds. So I think, on a moderated return, you have to remember what is the return that today you get on a safe bank FD. So I think that kind of a return equity markets can deliver with volatility over the next 2 years. What is required is that the government should be focused on growth, and they should be focused on increasing efficiency in the economy. If these 2 things are focused on by the government over the next 2 years, I think it is pretty easy for Indian stock markets to deliver. And I believe that the Indian government is very focused on growth, and I believe that they will be focused on growth in the next 3 years.
Naren, I have so many questions for you, but I know we've started late. You have a packed schedule. So we'll keep this FI selling debate, reserved for the next time. So thank you for joining us, and thank you for your time.
Thank you.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.